Hi, Professor Rex here. In this week's video, I'm going to focus on the two dividend stock portfolios in yellow in which we invest additional money on the first trading day of every week. They are the Dividend-Growth portfolio, which was started in 2022 and now has an annual return of 22.28%, and our HighYield stock portfolio, which has an annual return of 24.65% per year. The HighYield portfolio was started in 2023. On the chart, I've also included their benchmarks for comparison. Now, I recently started putting the list of dividend growth stocks we buy each Monday on a Substack newsletter. You can sign up for the newsletter for free. You can find the link to the Substack newsletter in the video description. Again, it's totally free to sign up for. I'm trying out Substack to see what it's like as a platform. And since I'm brand new to Substack, the newsletter is nothing fancy right now, but should get better as I learn the platform. In next week's video, we'll talk in depth about our newest portfolio, the tech stock portfolio that my accounting students and I started last year, as outlined in red, and now has an annualized return of 29.28%. It's one of our newest portfolios, and because it's 100% invested in tech stocks, it's our most volatile portfolio. Like our dividend stock portfolios, the tech stock portfolio is a real-world investment portfolio where I make additional investments on the first trading day of each week. So in effect, all three of these are portfolios that are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. Next week, we'll also talk about our wide moat and capital light portfolios, which are also beating the S&P 500, as well as our sector rotation strategy that we just started. As a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action would make for boring videos. So you can go online to read more about them if you like less frequent trading. They will soon be available on Substack as a separate publication and will be at a lower price than they are on our main website. Our dividend growth portfolio currently has 78 dividend growth stocks and 22 stocks that recently started paying dividends, while our high yield portfolio has 37 holdings and our tech stock portfolio has 25 holdings. Here's a summary of our investment strategies, their annual returns, when they were started, and where you can find them. The dividend strategies are my personal favorite since my goal is to generate passive income that is twice my annual expenses. The dividend growth stock portfolio seems to be the most popular, so I put it on Substack for free as an experiment to see if I like the Substack platform, and I may eventually switch completely to Substack. You can find most of the strategies on my website, beatthestockmarket.com, but if you can't afford a subscription, I alternate my weekly YouTube videos showing you the dividend stocks that we've been buying one week, and then in the next week's video I emphasize a tech stock portfolio, wide moat stocks, capital light stocks, and sector rotation. Now in the green box in the upper left, note that I've added a note that the tech stock portfolio and capital light strategy are both newer, and therefore the average investment has been held for less than a year. This means their annualized returns can fluctuate a lot until the holding period eventually grows. For example, the capital light strategy is by far the newest as it was started in February of this year. The average investment in the capital light strategy has only been held for 84.8 days and has a return of 9.46% over those 84 days. The annualized return of 47.57% should be taken with a grain of salt. All it means is if a stock's price increases 9.46% every 84.8 days, the annual return would be 47.57%. So just be aware that the annual returns for these two newer portfolios jump around a lot more, but should settle down over time as the average holding period gets longer and longer. This slide is showing the portfolio value over time of our original portfolio, our dividend growth stock portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth nearly $3,500 after 186 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks. We're buying fractional shares of stock. Each week we re-rate the stocks, so the list of top stocks fluctuates from week to week. And in August of 2023, we started a second portfolio, this time investing in high-yield dividend-paying stocks. So now the tan line on this chart shows what the portfolio value would be if we had just put it into a savings account. In our first year, 2022, stocks and bonds both did not do well at all. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really started to take off in November of 2023. Now, and like I mentioned before, I'll update our tech stock portfolio in next week's video, which we started in late April of 2024, and has been the best performing portfolio over that time. And for those that have been asking, all three of the portfolios are now on my website, beatthestockmarket.com. We post the stocks we're buying in real time on Mondays when we make our weekly investments, and anytime we sell a stock, as well as information about portfolio holdings and all of our trade confirmations. Because remember, these are real world portfolios with real investment dollars. All right, so before we get into the stocks we bought last week, a lot of people have been asking me for my favorite books about investing. My two favorite books were the basis for my 3 stock screens I publish monthly on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis for 2 of the 3 stock screens I publish on my website, beatthestockmarket.com. They are the Trending Value stock screen and the Consumer Staple stock screens. I update the stock screens monthly. So what's a stock screen? It's a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the price to earnings ratio, also called the PE ratio, dividend yield, etc., as well as combinations of those simple metrics. Now, there are a lot of tables and graphs, so if you're a numbers geek like me, you'll probably like it. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. So check your local library to see if they have it. Now, the other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. Same way with What Works on Wall Street book. Now, so Millennial Money is a much shorter book than What Works on Wall Street. So I'll put links to the 2 books in the description of the video. I'm also in the process of putting these stock screens as well as our legacy stock portfolios on a separate Substack for those interested in those strategies. Again, that'll be cheaper than on my website. So for investors who are afraid to invest when the market is near to all-time high, which we are now, and think they would do better by trying to time the market, good luck with timing the market, you might want to reconsider your position. A report from JP Morgan shows how investing at all-time highs led to higher returns compared to investing on a random day for time periods of 1, 3, and 5 years into the future, likely due to the power of momentum. Now, JP Morgan analyst wrote, investors usually use all-time highs as a reason to stay in cash or on the sidelines. However, history suggests that investing at all-time highs is not a bad strategy because new highs are typically clustered together. In other words, market strength begets more market strength. So don't try to time the market. Time in the market is more important than timing the market. And I'm always consistently adding, no matter whether the stock market is up or down, consistently investing more. Dollar cost averaging. All right, let's look at how our dividend growth portfolio is doing against 2 very popular dividend ETFs. So 2 very popular exchange-traded funds that only hold dividend stocks are the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD, and then you got the Vanguard Dividend Appreciation ETF, VIG. So here's how our portfolio is doing versus buying the exact, or on the exact same days if we put the exact same amounts into these 2 dividend ETFs. Now, I'm particularly interested in how we're doing against SCHD because I got a lot of money in SCHD. It's a large holding in my personal account, so I've been tracking its performance closely with our 2 dividend-paying stock portfolios. And as you can see, as of today, the average investment in our dividend growth classroom stock portfolio has an annual return of 22.28%, but SCHD has not done well over that time period, 6.27% annualized. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling out my personal SCHD holdings and reinvesting in our 2 dividend-paying classroom stock portfolios, as well as our other strategies that we talk about in our videos. I also prefer our actively managed classroom stock portfolio rather than SCHD's purely algorithmic approach, where there's no one overseeing the stock selection. SCHD has had, at times, value traps, and that's not a good thing. So this slide shows our best performing stocks for our original portfolio, the Dividend Growth stock portfolio, based on when they were initially purchased. Stocks in yellow, like Evercore and Crane Holdings, have been sold. So Broadcom is still in first place now with a 420.6% return. Evercore, an investment bank, is in second place with a 252.9% total return. And because it's in yellow, that means it's been sold. And Kellogg has recently been sold for a 110% return in 20 months. Now, the two worst performers are Adcore and Vestas Corporation. Those are two small, under-the-radar dividend payers. So we knew that they were risky going in. Fortunately, I made only one investment into each of those stocks instead of the average of 7 investments or so. But both are down 50%. These, like I said, these two stocks are categorized as under-the-radar dividend payers, which you can see in the strategy column over here. Now, so far, only 7% of our investments have been invested in those under-the-radar dividend-paying companies, which are defined as companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they're usually smaller companies, but studies have shown that historically beat the market averages by a significant amount, but with a lot of volatility, it seems, at least in my experience. The other 92% of our investments made in this portfolio have been made in the dividend growth category, which means that they are high-quality stocks with a great track record of increasing their dividend payouts to investors. Despite some of the huge gains in the under-the-radar dividend payers like Crane Holdings, 132% gain, F&G Annuities, 117.9%, and now WK Kellogg's 110.6%, and Repositrax 96% in 13 months. This category, even though they got some big gainers, they have been underperforming the dividend growth stocks. So in the future, I foresee investing a lot less in the under-the-radar dividend pairs. I mean, we're already only at 7% of the portfolio has been invested in these anyway, but I foresee even less than that going into the future. Now, this slide shows our best performing dividend growth stocks over this last week. We had some crazy numbers here. It does not include dividends. The best performers were West Pharmaceuticals at plus 25% and Lamb Weston up 24%. TMO, Thermo Fisher, which we've been buying a lot of, was up 15.3%. And GE Vernova was up 12.2%. And West Pharmaceuticals also recently, or this week, announced that they're raising their dividend. And let's see here. On this slide, we're showing our best performing dividend stocks this week for our high yield dividend portfolio. Now, that portfolio has far fewer holdings than the dividend stock portfolio. So the best gainers last week were Novo Nordisk, 11.5%, America Movil at 8%, Merck 6%, and GSK at 4.6%. And as a bonus here, our best performing stocks in our capital light portfolio over the last week. We got Thermo Fisher again, Deckers at 14.7%, Allegion, Schlumberger, Vertiv Holdings, General Dynamics, and Intuit. And that's a very new, the capital light portfolio is very new, so it doesn't have a whole lot of holdings yet. So here's the usual disclaimer. This presentation is for informational purposes only. It is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence. So let's talk about some stocks, or the two stocks we sold. Last week, WK Kellogg was acquired, so we sold it. We had 110.6%. Now, because when we sold that stock, we had a lot of proceeds to reinvest immediately. So we didn't want to reinvest it all at once. So we split the sale of WK Kellogg over 2 different weeks. The other stock we sold was Martin Marietta for 29.6% return. It looks to be fairly valued now, and fundamentals in that sub-industry, construction materials, seems to be getting worse. So we got out of that stock. Now let's talk about the dividend growth stocks we bought last week. I posted these rankings to our website, beatthestockmarket.com, last Monday, and to the Substack. Then we purchased the top 10 stocks. Now, The stock in yellow, which is Comcast, we did not purchase any more of it because that stock has makes up more than 4% of the portfolio. So we don't want our portfolio to get top heavy in just a few stocks. So we stop once the portfolio gets to 4%. Microsoft is another one that's over 4%. So remember, we use many criteria to filter stocks, and if a stock is hovering near the required level of a certain metric, the stock can make the list one week and then drop off the list based on a small movement in that metric. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. For consensus earnings growth estimates, I'll only purchase a stock for this strategy if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. That's why it's called a dividend growth portfolio. A stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means that the stock suddenly doesn't make the list at all. This is just one of many filtering criteria we use to narrow down our list of investable stocks. Now, just because a stock doesn't make the rankings does not necessarily mean we're going to sell it. Each week when we list the stocks we're investing, we also alert you about any stock we're selling from the portfolio. Like we said on the previous slide, we sold Kellogg and MLM last week. Now, each week we buy 10 stocks, and since we're investing such a small amount in this model portfolio, $12.50 each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends in the same stock from which the dividend was paid. Instead, each week when we're buying the 10 stocks as shown on the slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks we were repurchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we were purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. So the table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology here used here indicates that they're likely to continue to raise their dividends. Therefore, this is a dividend growth strategy. Now remember, this dividend growth stock portfolio is a model portfolio with real money, and it's in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So on my other main brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stock portfolio in the next few slides, and our other strategies that we talk about in our other videos. Last week, I purchased over $2,700 of the stocks from our various strategies, but mostly our dividend strategies, as I reinvest dividends and gradually transfer out of my main dividend ETF, which is SCHD, and buy these individual stocks instead. So on this slide, we have the same stocks, but I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 92% of our purchases. In other words, the dividend growers. The other, or I should say 93%. The other 7% so far have been invested in those smaller under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they're smaller stocks, but studies have shown that they historically beat the market averages by a significant amount, but their volatility has been pretty extreme, so I think I'll be investing in a lot less of those in the future. So of the qualities, risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. Because there's a lot of fraud out there, and especially in some of the smaller companies. Finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's rarely the way it works. Companies that are already paying out a higher dividend yield rarely have the greatest potential for the greatest growth in those dividends. An example of that on this slide is UPS paying a 6% dividend yield. They're not going to have much room to grow that, so they have a F for a dividends growth potential. Now let's talk about our quality rating. One of the components is Moats, a measure of competitive advantages. One advantage of companies with the best moats is if they pay dividends, they're more likely to increase dividends even during economic shock when compared to companies with no moats. Now on this slide, Morningstar shows their three categories of moats. On the top, we have the companies with wide moats, which is considered the best. This slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide moat companies were able to raise their dividends despite many companies being in financial trouble. Only 18% or so cut their dividends. Now for companies with no moat, which is at the bottom of the chart here, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. Now, our quality ranking for stocks includes moats, but it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only covers a 3-year COVID period. But during normal periods, dividend cuts are much more rare, and on average, companies increase their dividends 5.5% to 6% per year historically. On this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a lowly teacher salary. Historically, dividend-paying companies, as we mentioned in the previous slide, increase their dividends 5.5% to 6% per year, which is above the historical rate of inflation. That means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now, we had 6 dividend increases since our last video, including a huge increase of 33.3% by Goldman Sachs. And of the last 33 dividend increases for the portfolio, we have an average dividend increase of 8.3%. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single stock. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor. Therefore, we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. Now, it's true that our portfolio's returns would likely be higher if we always invest in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated, more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Now, our portfolio holdings currently are 78 dividend growth stocks and 22 under-the-radar dividend payers. Remember, those are stocks that recently started paying dividend and may become dividend growers in time. So that gives us a total of 100 stocks in the dividend growth portfolio. And as far as weighting goes, our investments, 93% of our investments have been in the dividend growers, and only 7% have been in the under-the-radar dividend payers. This slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Dividends for the latest month increased 69.04% over the previous month. This chart shows how quickly the dividends are growing in the portfolio, and it's a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. It can really help your finances. So let's talk about the high yield dividend paying stock portfolio. I've had several older students who are close to retirement take my classes, and they are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in their dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. To be honest, I didn't think that the performance would be very good since they have such a high dividend yield, but so far they've been beating our dividend growth portfolio. So the portfolio as a whole has an annual total return of 24.65%. Currently, the high yield portfolio's dividend yield, if you waited until today to buy all the stocks, would be 3.91%. Compared to our dividend growth stock portfolio, the companies in this portfolio likely will not grow their dividends nearly as fast. Therefore, this portfolio would be more geared towards investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, and we've been able to sell some stocks at a high price and reinvest into better bargains, pushing the portfolio's yield based on our original investments to 4.7%. Now, two strategies are being implemented in this portfolio, as you see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1, in an attempt to try to get the best of both worlds, that being a high yield and some dividend growth. Now, Strategy 2 has been the best performer. The average investment in Strategy 2 has provided a total return of 18.45%, and has been held for an average of 245.1 days so far, which is an annualized return of 28.69% using Excel's rate function. Now, we don't sell stocks often, so this average holding period will eventually increase past a year. Now let's talk about the high yield dividend paying stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday, and then we purchased these 8 stocks. And notice there's going to be some duplications in these two strategies. Now, as I said, one thing that's different about the higher yield strategy versus our dividend growth strategy in the 2 previous slides is we only purchase 8 stocks and we have 2 different strategies within this portfolio. Strategy 1, in red, emphasizes a high dividend yield over dividend growth. That's perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. And so for Strategy 1, the 4 stocks we bought were Novo Nordisk, Comcast, Merck, and GlaxoSmithKline, which is now officially called GSK. And for Strategy 2, in green, we've got Comcast, Merck, PNC Financial, and PepsiCo. And here's a look at last Monday's ratings for competitive advantages, management, and financial health for those same 8 stocks. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower on average than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. Now, a lot of subscribers are combining both portfolios, the dividend growth and these higher yielders, which is what I'm doing too. That's it for this week. In the comments, let me know if you have any questions, and also let me know what portfolios or investment strategies you'd like to see more of. Finally, here are the places you can reach me: YouTube, obviously, as well as our website, beatthestockmarket.com, Substack, LinkedIn, and Twitter. I'll talk to you next week with another portfolio update, most likely about our tech stock portfolio, wide moat strategy, capital light strategy, and our sector rotation strategy. See ya!